Well, British American Asset Managers outlined its second quarter economic outlook for Kenya this morning at a press conference held in Nairobi. And joining us now live from our studios over on that end is General Manager of the company, Onchera Maiko, to share his perspective on the economy, but also on the impact it's set to have on the trends in terms of investment moving forward. Onchera, thanks so much for joining us this afternoon. Well, first and foremost, making headlines this week has been the fact that we've seen the Finance Minister asking Parliament for an extra 42 billion shillings in a supplementary budget for this year. What have you overall made of that request?
Thank you. The request by the Finance Minister, which culminated in presenting it to Parliament yesterday, was something we had expected for a while. Basically, what you had is a slow economy last year, and government expenditure was therefore higher than was expected. But we had expected this actually after looking at the budget last year. So he was just going to Parliament to tell them, I need a bit more money to tide me over. We had a drought, had to import food, had to actually pay for electricity through emergency power suppliers. And here is the bill. And I don't think it was so extraordinary, except that it happened this week, and so it made the news.
Well, in a broader economic context, then let's look at how this is planning to be funded, because we know that the Eurobond issue for at least $500 million has been put off until we see more steady progress in terms of a global economic recovery. In that context, where the government has leaned on domestic borrowing to fund, to raise funds, being reiterated by the Finance Ministry now is that this request does not mean that the country will borrow more from the local market. So how exactly is the government being expected to fund this request?
In fact, what he actually said is that he requested 42 billion extra in supplementary spending, but he did state that a portion of it would be funded through the local market. So I think what he meant is that out of the 42 billion, 16.5 billion of that 42 would come from the local capital markets. And our estimate is that in the current circumstances, the local market would easily provide the money.
Let's take a look at impact you see this having on the investment climate then in Kenya, where, yes, we have seen a lot of interest being diverted to the local bond market. But once this recovery in the equity segment is coming through, we're seeing investors divert their attention to equities more so. So let's take a look at how you see the trends playing out over the next 6 months.
In fact, the way we see it is the following, is that during the dry period of 2009 and 2008, since the credit crunch, we've had a very strong interest in the bond market, as most people were very shy of equities and saw them as unlikely to provide them reasonable returns. What has happened is that that combined with automation of the local bond market that had been very manual until then, and in fact, bonds traded in the first quarter of 2010 were actually higher than that traded in the entire 2009. So there's been a very strong interest in that market. Underlying that has been a very critical central bank policy. Central bank has actually looked at the Kenyan market and felt that the interest rates were too high because of a mismeasurement of inflation. Late last year, Kenya instituted the use of the geometric mean in measuring inflation, and that brought down inflation to about 7%. The most recent number is 4%. Following that, the government itself pushed down yields for one-year paper to below 6%, and this is expected to keep falling. And as a result of this, the banks, I think I heard you mention, Barclays reduced its base lending rates. The Cooperative Bank followed this morning, and we expect that to continue. How will that affect government borrowing? During 2010, not at all. I think there's enough liquidity sloshing around because the economy was laid down, was in a very slow rate of growth. So there is no competition for funds. I think to the extent that this might have an impact, it's at least a year, 2 years down the line, because this is an economy coming out of a very slow period. So there's a lot of liquidity.
In light of that kind of activity that's being anticipated on the fixed income side of things, and how do you see things playing out on the NSE, where, yes, we are looking at economic growth, we're looking at possibly now more lending towards the private sector and anticipated better earnings from many of these corporate players as well?
I think it's a perfect scenario for Kenyan equities for the following reason. We had a very slow economy, so we had a strong interest in bond markets. Enough to give people confidence generally in investments, but the returns on fixed income investment have fallen enough that people are starting to look at equities as just as an asset class. On the pure real economy, the falling rates, greater confidence, because you probably know that there's a constitutional referendum coming up, and most people expect it to come through with the new constitution. So there's very strong business sentiment. 2 studies were done, one by a company called Sinovate based here and another company called TNS Research International, that found that business sentiment in Kenya is now back to where it was in 2007 before the complicated period the country went through. So the strong business confidence is expected to push GDP growth rates to 4% in terms of our in-house estimate. The government has it higher at 5%. But either way, we are confident that GDP will be positive. This should actually lead to better profits. And if at the same time companies are able to borrow money at a lower cost, we should see a very strong profit return during 2010. And given the positive sentiment locally, not to mention internationally, if you skip over to the international environment, where I'm sure the rest of your programs focus on, you will see that returns out there are not going to be very strong. They're going to be positive, but not very strong. So international investors are venturing abroad to frontier markets and saying, can I actually get returns with a reasonable risk? And we believe that that will favor markets like Kenya, Sub-Saharan Africa in general, and Kenya, because in Sub-Saharan Africa, ex-South Africa, I think basically you have Kenya and Nigeria that are the more liquid markets. Because one of the problems you have is,